With great pleasure, we're going to bring in Randall Quarles. He's former Federal Reserve Vice Chair under President Trump. Randy Quarles, good to see you. You were the guy in charge of supervision and regulation. Yours was a separate vice chair. And so let me ask you, first of all, what do you think of the assistance program that was announced last night?
Well, I think it'll be effective in stemming the pressure on the banking system over time. We wouldn't have expected it to be immediately effective, but the size of the Fed's facility and their willingness to take securities at par rather than at a discount and at a non-penalty rate, it will cover all of the uninsured deposits in the system. So there's really no reason for continued pressure on the system. And bank runs aren't reasoning, but ultimately, I think reason will win out. So my understanding is that some of the pressures that were still there this morning because people had put in place decisions to start withdrawing money from some banks first thing this morning, those went through, but that the pressures have begun to abate, and I think it will stem the time.
You know, first of all, I sure hope you're right. That's the most important point, because nobody wants to see a collapse. But Randy Quarles, as the top Fed bank regulator during the Trump years, would you have done the same thing that they did, the FDIC, the Treasury, and the Fed?
Well, I think I would have pressed harder, as you were discussing in the earlier session. I think I would have pressed harder for a private sector solution. This is a pretty attractive franchise, this bank. Its fundamental business, its customers would be attractive. I think that if the FDIC were really working at it, it would have been possible to find a buyer over the weekend. If they have been reducing the universe of buyers, artificially excluding some people, if the terms have not been appealing, because the way this works, as you know, Larry, a buyer comes in and negotiates with the FDIC over how much of the potential losses in the institution the FDIC will cover in order to induce that buyer to quickly buy the firm, because you don't have weeks and weeks to do due diligence on the institution. And if the FDIC isn't being forthcoming on that, then you're not going to have a private sector solution. And I would have preferred, this solution will work, and I support it given that there wasn't a buyer. But I think if the FDIC had been working harder, there would have been a buyer over the weekend.
Randy Quarles, let me play you some tape from something President Biden said today about regulation. Hang on a second, please.
We put in place tough requirements on banks like Silicon Valley Bank and Signature Bank, including the Dodd-Frank law, to make sure that the crisis we saw in 2008 would not happen again. Unfortunately, the last administration rolled back some of these requirements.
Unfortunately, the last administration rolled back some of these requirements. What do you think about that? Do you agree with them or not?
Well, I think that that's wrong, obviously. We did refine a number of the banking requirements. None of those were at issue in what happened with either Silicon Valley Bank or Signature Bank. None of the capital changes that we made had anything to do with what happened at SVB. None of the liquidity changes that we made had anything to do with what happened at SVB. I think that there are interesting questions to ask about how you can improve regulation and supervision going forward, dealing with the performance of uninsured deposits in this new world where Twitter amplifies and accelerates herd behavior. So the liquidity rules that have always applied, the Trump administration didn't change anything about this, to uninsured deposits, treat them pretty leniently, pretty close for liquidity purposes, for the stability of a bank's funding, to insured deposits. They generally don't run all that fast. They haven't over history. So now in this new world of Twitter and social media, maybe they should have a bigger haircut. That's nothing that we change. That's always been the case in the liquidity regulations that were put in place after Dodd-Frank. It's worth thinking about, and certainly worth thinking about how you look at uninsured deposits as a supervisory matter, even apart from a regulatory matter. But the idea that anything that was changed had anything to do with what happened at SVB is just wrong.
Right, because this is fundamentally a liquidity issue, liquidity mismatch. This is the upside down curve. But I thought, Randy, that some of the deregulation was to take reporting requirement burdens off of the smaller banks and the community banks, but you left the stress tests and whatnot on the large banks. Now, I don't know. Maybe they didn't stress test this bank. Can you comment on that? What do you think has happened here? I mean, it is a mystery that they so badly managed their risk management on the security bond portfolio. I mean, the mismatch between assets and liabilities. That's something of a mystery. You would think professionals would do better. But I don't know. What do you think?
Well, I agree that is a mystery because it's been fairly clear what the mismatch was, and it's been fairly clear what the Fed's path for monetary policy was going to be for a long time. The Fed has been as transparent and as articulate about what the path for monetary policy is going to be as any Fed in history. So they should have seen this coming, and if they'd reacted soon enough, you would have been able to adjust the bank's portfolio of investments so that this wouldn't have been as big of a hit. Can't tell you why it is that they didn't. But I can say that it's not really a function of anything regulatory. It is, as you said, it's an old-fashioned bank run, and there's no way you could. There's all the capital in the world is not going to protect a bank that has $40 billion withdrawn from it in the course of a few hours.
All right. Randall Quarles, we appreciate it. Formerly the Fed's top regulatory and supervisory person. We appreciate your time.